Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, I Tell.
All right. Hey guys, you heard the man. My name is Mark Eitel, and you are dialed in to the Mr. Mortgage Show. We are super excited to be with you this week. We've got an awesome show lined up. There were a lot of headlines. Are rates going up? Are they coming down? Some of the Federal Reserve governors say they want to see a lot of positive inflation data before considering any rate cuts, while others are saying, maybe we'll get to it later this year. So as the world turns, everybody is still super confused. However, the Fed's been pretty clear, Jerome Powell, in his public speaking engagements, that it's most likely going to be 2025 before we see any rate relief from the Federal Reserve. So if you're one of those guys who have been sitting on the fence, holding your breath, waiting for a rate cut, you might be sitting there turning blue a little bit longer. But we're going to dive into that. We're going to cover so much more. If you have questions or comments along the way, I encourage you to call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. And Jen, my producer extraordinaire, is back there behind the board, working her magic as well as womaning the Anytime Hotline. She'll get your questions on the air. Just call or text that number, 855-462-7292, or you can head over to MrMortgageRadio.com. That's MrMortgageRadio.com. That is the most convenient place to find everything related to the show, related to our national mortgage brokerage team, as well as get your questions on the air. There's a big orange button in the middle of the screen. You can't miss it. It says, get your questions on the air. Imagine that. Click that button, fill out the form. It'll pop up on our end, and Jen will read your questions on the air. Hey, I wanted to touch on this Gallup poll that was released by CNBC. I found it pretty interesting. 76% of Americans surveyed said, now is a terrible time to consider buying a home. And you know what? On the surface, I don't blame you. I agree. There are a lot of downsides right now. Prices, interest rates, taxes, insurance, everything is at an all-time high. So if you're looking at it purely from an opportunistic standpoint, which we saw during the COVID pandemic, there were a lot of people who bought and sold, not because they wanted to, because they saw the opportunity and felt like this is a once-in-a-lifetime opportunity to sell and capitalize on all of this ridiculous equity, right? People were showing up at the doorstep with bags of cash and waiving appraisals and waiving inspections, and they were like the prom king and queen in the parade. They were waving at everybody. Foolish behavior. Some of it encouraged by their agents, some of it encouraged by the fear of missing out and desperation. But man, that was very dangerous behavior. And some people are paying the price for that. They bought properties that needed significant repairs, but they had waived all their inspections and didn't do their due diligence and moved in and found out they needed a $40,000 roof or an $18,000 HVAC upgrade. So I don't think we're going to see a lot of that moving forward. So I'm encouraged by that. But yeah, 76% of people say no go for me right now. And that's only slightly improved from last year's 78%. Now, with that being said, there are a lot of good reasons to buy and sell real estate just about any time in life if your number is called, right? If you're moving, if you're relocating, if you need to upsize, right? Additions to the family require more space, or you're downsizing. You want to move closer to the kids. The big house is too much. People still have a load of equity and are able to make deals out there. And there are ways to work around the environment that we're in. There's still a lot of opportunity out there. And we're seeing more and more opportunity every day. And I know that sounds counterintuitive to what I just said, but think about this for a minute. A year ago, 2 years ago, people were paying significantly over the asking price and all of that crazy waiving that we talked about just to buy a property. Well, we're not seeing that. People are doing their due diligence. They're getting appraisals. They're getting inspections. They're doing all the right stuff. And the average sale to list price, right? How much I'm asking for it versus how much it's sold for. In our Florida markets averaged, right? Because although the show is national and our team is national, we broadcast from our headquarters in Florida. So I just pulled local data. I looked at Florida. We're averaging about 96% of the list price is the sales price. That means there's a 4% on average discount that can be negotiated. Well, guys, use that 4% for a permanent rate buy down. Not one of those crazy date the rate, marry the house 3-2-1 buy downs or 2-1 buy downs, because people are haunted by those right now too, right? That rate that you were dating for a year or two because somebody convinced you they were going to be significantly lower at the beginning of 2024 turns out to be, the roommate that won't leave, the Uncle Buck that's overextending their welcome. They're laying on the couch eating Lay's potato chips and a wife beater with a belly full of crumbs, drinking Mountain Dew out of the 2-liter, watching their stories all day, the soap operas. They're not leaving anytime soon. So if you bought into that whole temporary pleasure and just took the 2-1 or 3-2-1 buy down, you may be in that adjustment period where you're paying the start rate again, and it's maybe more than the rate of the day, which is interesting because had you taken that 4% discount that we just referenced and bought your rate down from today's published rate with no points was 7 1/8, you could buy that down to 6% comfortably with that amount of a discount, which is a significant savings on a $450,000 purchase with 10% down. That's $300 a month, every month in perpetuity, because it's a permanent rate buy down. That's an opportunity that didn't exist not too long ago. Another place that's standing out right now as a wonderful opportunity is assumable mortgages. Did you know a VA mortgage is assumable by a non-veteran? Now, that's a very uncommon thing. A lot of people don't know that exists, as well as FHA mortgages and USDA mortgages being assumable. Assumable mortgages are all the rage right now. There are specialty websites popping up like the startup from last year, Roam, ROAM, withrome.com. It's only featuring sellers of properties who've agreed to go through the assumption process with the buyer. Huge opportunity that didn't exist a couple years ago. And you're seeing rates in the 2s and 3s with assumable mortgages. And I think Realtor.com even jumped on board and has a tab at least, or a category on their website. I didn't research this. I just saw this pop up when I was looking at some things in my show notes featuring properties with assumable mortgages. So I think we're going to see more and more of that. That low interest rate is certainly super valuable right now, and people on the sell side can capitalize on it. And suddenly they're not negotiating price because they've got that trophy interest rate to sell with the property. So all things to consider. Now, another thing to consider is investment property. And I know that sounds crazy to a lot of people because where prices are right now, it seems counterintuitive. Like, man, I can't pay these high prices and still rent at a profit. But rental rates across the board in most metros are still going up. As taxes go up, insurance goes up, and all of the costs of owning real estate go up, the landlord's passing that on to the tenant. So properties are still cash flowing, and every single day that a price increases or an interest rate increases, more and more people are being priced out of the market. There's more and more rental demand. And things like that landlord loan that you hear us talk about requires no personal income in the underwriting. If the property cash flows and you've got the credit requirements and you've got the asset requirements, boom, you're a landlord. So guys, yes, it is a difficult time to buy across the board, price-wise, tax-wise, interest rate-wise, but there is opportunity in the market, and that's what we like to focus on. Hey guys, you hear the music? You know what that means? That is my cue. We'll be back in a few. Sit tight on the other side of this very short break. We're going to jump into my favorite part of the show and start taking your questions live on the air. Sit tight. We'll be right back after this short break.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And I'm laughing because I just ran out to grab a bottle of water, and I ran back in here and almost missed my chair as I was sliding my headphones back on. So I'm glad the mic was muted because that was a near disaster, and you would have heard me dropping the F-bomb as I was falling out of my chair. But anyway, guys, thank you so much for spending a little bit of your day with us. As always, it's our goal to bring you the information that you need so you can make better real estate and mortgage decisions for you and your family. And you know, I say it all the time, your questions are my favorite part of the show. And I know Jen just tipped me off that we've got some questions over there. So let me throw it over to Jen and we'll dive right into your questions. Hey, Jen, what do we have question-wise?
Ron is asking, I currently don't work, but I have plenty of money in the bank. I can pay cash for a house, but prefer a mortgage. Are there any loans for this scenario? I have excellent credit. Thank you.
Hey, Ron, great question, my man. And congratulations on having a big old mound of money in the bank and not having to work. But I'm sure you worked hard for it your whole life and now you're just enjoying your time. So anyway, brilliant question. And yes, there are loan programs for that exact scenario. So there's a couple of programs that jump into mind, and both of them are no ratio programs. And how they work is if you've got the cash in the bank to put typically 20% down payment, and then the remaining money in the bank is enough for you to get through the next 24 months. So that you'll hear the term reserves. What reserves means is the cash on hand reserved for making the payment. So if you've got enough money to get through 24 months, typically the down payment plus 24 months reserves and you're good to go, especially if you mentioned you've got good credit. So the credit score for that program typically goes 620, 640, somewhere in there, depending on the lender and depending on the program. So that is the first thing that jumps into my mind is the no ratio program. And a spinoff of that is there's an acronym, ability to pay in full. And that's a variation of the no ratio program where you're just verifying that you've got the cash, you could pay cash. And in that case, there's little risk to the lender because they see your ability to pay for the loan if you had to. So great question. And we see a lot of that in the case of recently divorced couples. And historically, it's been the wife who is the stay-at-home mom. Although we're seeing this change, but I'm just saying historically that those have been kind of the traditional roles. And she may be at home for 15 or 20 years, raising the children, running the household, which is, we all know, CEO level stuff right there. But oftentimes that one spouse who was tasked with all of the management of the home didn't have a quote unquote job. And upon divorce, there might be a nice lump sum settlement. So we see that program often where the one spouse receives that large settlement, if you will. So they've got the cash, they just don't have the work history. And we're using the no ratio or the ability to pay in full programs to get him or her into their new primary residence and on with their life. So brilliant question. We see it often enough to know that those programs can make a huge difference. So I appreciate that, Ron. Hey, Jen, do we have another question over there?
Ernesto sent this one. Do all first-time buyer mortgages have mortgage insurance?
Wow. Hey, that's another great question. And I don't think mortgage insurance gets explained often enough or well enough. So I'm going to dive into that real quick. And Ernesto, the mortgage insurance isn't required for first-time buyers. It's required for anybody who borrows more than 80% of the purchase price. So historically, lenders have established that they have a comfort level with the risk at 80% or less. So let's use a very, very round number. And I know this property does not exist out there today anywhere but maybe Fantasyland. So let's say there's a new listing in Fantasyland right on Unicorn Lake behind, Rainbow Mountain, and you can buy that property for $100,000. Now, the lender is comfortable loaning you $80,000 because they assume that if they have to go into foreclosure, that additional $20,000 in equity will pay for all of the associated costs and the back interest to get their money back in a foreclosure. So historically, 80% has been that, that safe area, if you will. Mortgage insurance is required when you borrow
more than 80% because now the lender is extending beyond their comfort level with risk. So if you borrow 90%, 95%, 97%, the mortgage insurance is required on the amount above the 80. So in the case of a 95% loan, the mortgage insurance insures the lender on that $15,000. So regardless of first-time buyer or if you've owned 90 homes, 100 homes prior to this, if you borrow more than 80%, that mortgage insurance is required. Now, oftentimes, first-time buyers are borrowing more than 80%. So that's where that connotation, that's where that correlation is made, where often you'll hear people assume that first-time buyer is required to carry mortgage insurance. But I hope that helps. I think that's a brilliant question. In the old days, to get around mortgage insurance, you saw people taking a first mortgage of 80% and then a second mortgage. And this is starting to come back in fashion a little bit right now. A second mortgage of, say, 15%. So you've got a first mortgage of 80 and a second mortgage at closing of 15%, which is getting you to 95%. Loan to value is the term that we use, but you're not required to carry mortgage insurance. Now, interestingly enough, the second mortgage always has a higher interest rate than the first mortgage, but the interesting part is blending that payment together is still a savings in some cases monthly than just paying that mortgage insurance. But one interesting thing about mortgage insurance is, with the exception of FHA, if you pay that balance down over time or the property appreciates over time to where the outstanding loan amount is now 78% or less. I know I said 80, but that's the threshold for a purchase mortgage. But once you reach 78% or less of the value with your outstanding mortgage balance, you can ask for that mortgage insurance to be dropped because it's only protecting them on that amount over the 80%, or in this case, 78. So getting it dropped over time, you're going to hit that 78% loan to value. Purchasing the property, they're looking at 80% loan to value. So I hope that helps, but that's a brilliant question. And I know sometimes it feels like you're insured against everything when you buy a house. You've got title insurance, flood insurance, homeowners insurance, mortgage insurance, insurance upon insurance. But anyway, thanks for that question. You hear the music. You know what that means. That's my cue. We'll be back in a few. Sit tight. On the other side of this break, we'll be back with more of the show. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. Guys, if you have questions or comments, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. That's how you get your questions on the air. Just call or text that number, 855-462-7292, or head over to MrMortgageRadio.com. That's MrMortgageRadio.com, and click that big orange button that says Get Your Questions on the Air. Type it in there, follow the instructions, and Jen will read your questions on the air. But speaking of Jen and your questions, let's keep them coming. Hey, Jen, throw me another question.
Billy sent this text. I want to start flipping properties. Where are the best places to find foreclosures?
Hey, Billy, not deterred by that opening segment, I see. You are going to be a foreclosure hunter. Hey, that would be an awesome HGTV show, Foreclosure Hunters, where Billy goes out and finds properties to flip. I would watch that. Who would watch that? I know people would tune in for that. Hey, Billy, great question, my man. If you're looking at HUD foreclosures, which are FHA foreclosures, you would go to HUD, HUD, homestore.com. That's where the HUD inventory is liquidated to the public. And it's done based in groups, right? They'll first assign a property to a group that's only being released to people who are going to live in the property, buy it as their primary. And then the longer that it's on the market, they'll release it to larger and larger groups of potential investors. So HUDHomestore.com is a great place to start. Auction.com is another one. Auction.com liquidates a lot of the conventional mortgage foreclosures. But if you want to get a head start on everybody who is just searching the sites, go to your county's website, Clerk of Court's website, and search for lis pendens filed by mortgage companies. Lis pendens, 2 words, Lispend, I think it's IS, pendens, ES, pendens, lis pendens. I think the direct Latin translation is lawsuit coming. It's the document that's filed before everything else to let everyone know that there is a lien or an action that's going to be taken against that property. So the very first step in a foreclosure process is that lis pendens. And if you go and do that research, you're ahead of everybody. You're in that 778-day cycle before the rest of the world even knows that that foreclosure is coming to the market. And with that information, you could either call or send letters or go, if you're feeling daring enough and you're being filmed by that HGTV crew, go knock on the door. Just see if the people are interested in selling before the house goes through the foreclosure process. A lot of times people are just embarrassed and they don't know what their options are. And if you can, get them early enough in the cycle, you too may be able to strike a deal that's great for everyone. So search the local county clerk of courts for lis pendens or hit those other websites. But great question. If you need some more information, just shoot me an email. I'll help any way I can. I was a foreclosure hunter back in the day, so maybe I can give you some words of wisdom or at least some things to be cautious of. Okay, Jen, throw me another question.
Joanne has this one. This may be a dumb question, but what's the difference between a second mortgage and an equity line? There's no such thing as dumb questions.
That's true. No dumb questions. So an equity line is a second mortgage. It's a lien behind the first mortgage. The equity line is like a credit line. If you need some money, you can borrow against it. You can pay it back. It's there if you need it again. You can borrow against it. Where a traditional second mortgage is one lump sum of money. And you can get a first and second combo when you buy a property. You can get a first and an equity line combo when you buy a property. But most people's questions around second mortgages at this stage of the game are cash out seconds. And how that would work in relation to an equity line is you would close that second mortgage. It takes a second lien position behind your current mortgage. You get a lump sum of cash and you're paying it back just like your first mortgage. It's just another payment. And they could be 15 years, 20 years, 25. There are some 30-year second mortgages, and you just keep paying until it's paid off. So one is a closed end, take the money one time, and the other is an open end, and you can draw against it, pay it back, draw against it again, and use it kind of like a credit card, if you will, that's collateralized by the equity in your home. So I hope that helps. That's a good question, though. Thank you for that one. Hey, Jen, do we have time for another? Go ahead.
Eric used the website. I'm ready to start buying rental property. What are the pros and cons of buying a duplex versus a regular house?
Hey, that's a great question, and thanks for using the website. There's not a lot of difference. Some people think a single-family residential property is easier to resell when the time comes. So some people will tick the box that that's a pro. A lot of people like the duplex because it's 2 income sources. A triplex would be 3 and a quad would be 4 under typically one roof. One set of exterior walls to maintain. So they like the idea that there's multiple streams with less cost per square foot to maintain it. that could be a plus in the multiple family side of things. The mortgage loans are pretty similar for buying investment property, with either a single family residence up to a 4-unit property. So there's not a lot of difference there. But great question. If there's something specific that you are curious about, just shoot me an email and or call me off the air, and I'll be happy to discuss it with you. They're very, very similar in the loan product. Maybe reselling a single family residence might be a little bit easier, but who knows? A lot of people are house hacking and buying that multi-door property as a primary also, which you can do, guys. You can buy a 1 to 4 unit as a primary residence with an FHA loan with as little as 3.5% down, and new rule change coming into effect later in November with as little as 5% down on conventional financing. So certainly leveling the playing field when it comes to that. But great question. Hey, Jen, throw me another.
Doug emailed this. I've heard that if I write a contract with an FHA buyer and the appraisal is low, I'm stuck with that appraisal if someone tries to buy it later. Is this true?
So, Doug, this is a great question, my man. I'm so glad you asked this, because with where rates are right now, FHA rates are considerably lower, and people are leaning on that product right now. So people need to be aware of this. If an FHA buyer goes under contract and for whatever reason falls out of contract, but they had the appraisal done, that appraisal does live with your property for as little as 90 days, as long as 6 months. That's true, but that's only for another FHA buyer. If it's a conventional buyer, that FHA appraisal is irrelevant. It's only assigned within the FHA underwriting system. So a conventional lender is never going to see it. They're never going to look for it. It's irrelevant. The same applies for a VA loan. And this is where people get super confused. They treat the VA appraisal and the FHA appraisal as the same set of rules. But the VA appraisal lives with the veteran. It's attached to the veteran. So if they fall out of contract and another veteran puts a contract on your property, that first VA appraisal is nowhere in the system. That is a huge misconception. You're right in the context that it will affect the next FHA buyer, but it won't affect a conventional buyer nor a VA buyer. And that's true if a conventional or a VA transaction falls apart. The next conventional or the next VA transaction, that first appraisal is also irrelevant. So great question. I hope I didn't confuse you. If you need more info, just reach out. That was a good one. We get that one a lot. Hey guys, you hear the music? You know what that means? That is my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right. My name is Mark Eitel, and this is the Mr. Mortgage Show. Guys, you heard the man, 855-462-7292. That is the Anytime hotline. You can call or text that number, 855-462-7292. Or head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Right in the middle of the screen is a big orange button. It says Get Your Questions on the Air. Go ahead and follow the instructions. Hit submit. Your question will pop up on our end, and we'll do the rest. But speaking of questions, let me throw it over to Jen and see what we've got. Go ahead, Jen.
Todd texted us this. If we take a reverse mortgage, are we able to sell the house later if we decide to move? We'll probably never move, but I don't want to be forced to stay either.
Hey, Todd, that's a great question. And you said something key in your question. can you sell the property and move? And the answer to that is yes. There is no prepayment penalty on a reverse mortgage. You can sell the property, you can refinance it, you can pay it off in full and stay should you wish. So in that sense, you absolutely are not restricted. You'll be able to sell and relocate should you wish. Now, here's the thing. If you choose to move and make another property your primary, then that note can be called due because the reverse mortgage has to be on your primary residence. So don't think you're going to take a reverse mortgage on your primary residence and then go downsize and move into a condo and rent the primary out, because that's now no longer your primary, the condo is. And in that instance, you would be forced to pay the mortgage off. So, but in your question, you said, can I sell and move? And absolutely you can. There's no prepayment penalty. But I just wanted to throw that out there because a lot of people love the idea of taking the reverse mortgage and then later downsizing and turning the primary into an income producing property. That is not allowed. I hope that helps. Hey, Jen, throw me another question.
Roberto sent us this one. I've been RVing since the pandemic, and I'm ready to settle down in Texas. I haven't paid rent or had an address for 3 years. I kept a P.O. box in Florida for a mailing address, and my sister checks it for me. Do I have a shot at getting a mortgage?
All my exes live in Texas. And that's why I reside in my RV. Hey, Roberto, very, very cool. And I want to say, yes, this is a doable deal. And I'm going to tell you why. During the pandemic, Jen's back there, the face she's making, I wish you guys could see it on the radio. So during the pandemic, we were able to close a transaction for a couple that lived in their RV for over a year, and they had a fantastic time. They were locked down. They were frustrated. They were able to run their business over the internet, and it sounds like that's what you're already doing. They RV'd for a little over a year, saw the entire country, decided to relocate to Florida, and we were able to establish that during that time, their business income did not suffer. As a matter of fact, their business grew. It took some extra documentation and a little creativity, but we were able to get them approved for a primary residence. In this case, it was in Florida, but the same would apply in Texas. So great question, my man. And I would love to talk to you and hear about your adventures over the last year. What did you say, 3 years? Man, super, super cool. But yes, to answer your question, you should be able to be qualified for a mortgage. Extra paperwork, and we're happy to help if you need somebody. I appreciate that one. Hey, Jen, throw me another question.
Tabitha sent us this. So we tried to get a HELOC, but our bank said we have too much debt and our credit scores are too low, probably because of the high balances. We haven't missed any payments, but really want to pay some things off. Do you offer a lower credit score equity line?
Too much debt on my hands. What was that, Styx? Too much time on my Anyway, I apologize for the singing. I don't know what's gotten into me today. I told you I was highly caffeinated. So here's the thing. You're not alone in this, Tabitha. A lot of people are experiencing this exact scenario. The banks are increasing the credit score requirements for HELOCs, home equity lines of credit, and they're lowering the percentage of the value that they're willing to lend. So a lot of people who were going the HELOC, in addition to the HELOC rates have gotten quite a bit higher than most people have expected. It's really, really interesting to see what's happening. So your scenario fits the bill for a lot of people. A lot of people are going through this. And the way the debt to income is calculated on the equity line is different than the REC refinance. So to answer your question, there's not a low credit score equity line. Our equity lines have a wider range of credit scores, so we might have a broader offering. But here's something to consider. The REC refinance, the debt to income calculation is done after the proposed debts are paid off. So you mentioned you feel like your score is pulled down because you have a lot of debt. Well, in the world of the REC refi, REC, reduce, eliminate, and consolidate, we're able to take those debts out of your debt to income ratio now. So if you're going to pay off a car payment and a couple credit cards, boat, whatever it is, we take that out of the equation and qualify you with the new mortgage payment. So you're paying off your first mortgage, and yes, most likely your interest rate is going up, sometimes significantly on the first mortgage, but the interest rate and payments comparably on everything else is coming down. So oftentimes there's a significant monthly savings. Not always, sometimes it doesn't make sense. But if you've tried the equity line route and have not been approved, check out the Rec Refi. You may be surprised. Go to RECREFI.com. Anybody can go there. It's an explainer video. There's a debt consolidation calculator in there. You don't have to punch in your email address or phone number. It's not one of those deals. It's out there for everybody to use. And see for yourself if the Rec Refi makes sense. RECREFI.com. I hope that helps. And I'm always open to discuss specifics if you need more information. Just give me a call or shoot me an email and we'll set up a phone call. I appreciate that one. Thanks. Hey, Jen, throw me another.
Vince used the website. How fast can we get a mortgage? We found the perfect house and don't know where to start. We verbally agreed on a price, but the seller wants our approval before they'll write a contract. No agents are involved.
Hey, Vince, thank you for using the website. I'm super excited that you pressed the big orange button. But to answer your question, man, we can move as fast as you can. So I tell everybody, we drive the bus, but it's your foot on the accelerator. And what I mean by that is if we can get the documents in and get your complete application in, you can have your approval in a couple hours. You know, let's say half a day to play it safe, but we're turning them in a couple hours. But it really depends on how quickly you can provide the documentation. That is if you want a bona fide approval. And I guess the hierarchy of approvals kind of go like this. Pre-qualification means that you just give somebody your information. Hey, my name's Vince. I make X amount a year. My credit score is this, and I've got about this much in the bank. And they'll say, okay, Vince, based on that information, you should be qualified, air quoting qualified, for a mortgage of X with an interest rate of Y. An approval, a pre-approval, your documentation is actually verified. You're uploading your bank statements. Somebody's reviewed your credit report, and they tell you that you are approved based on the documentation that you've provided. And then the next level is actually running you through the underwriting system. It's called AUS, Automated Underwriting, and it spits out either a conventional FHA, VA, USDA approval. And that approval says, assuming that everything in this application is accurate, and that's why we ask for the documents to review everything, this mortgage is fundable as one of these loan programs, then all you need to do is find a property, the property appraises, the property meets the guidelines of the loan program, and you're up and running. So if you want a bona fide approval and you can get all your documentations in the morning, it's not out of the realm of reality that you have a bona fide AUS approval by the afternoon to submit with your offer. And if you're looking for somebody right now, my hand is in the air. Guys, if you can hear my voice, my team can be your choice. Everywhere the radio show is, my team is as well. Everywhere but New York, that is, by the way. So, but Vince, if you are seriously in the need of something right now, just give us a call, and Jen will put you on hold. When we get off the air, I'll jump on the call with you, and we can get the process started. Guys, that's just one more example. Vince went out there and found a place in this market that he wants to make a move on. So I'm happy for you, brother. We're here if you need us. Guys, you hear the music? You know what that means? We have wrapped up another week of the Mr. Mortgage Show. Hey, Vince, it's perfect timing. If you need me now, I'm going to be off the air here in a few seconds. Guys, if you need us during the week, head over to MrMortgageRadio.com. That's MrMortgageRadio.com. One more time for the kids in the back, MrMortgageRadio.com. Otherwise, Jen and I will be back next week right here, same time, same station. Guys, have an awesome week.